ticker that I'm going to analyze for you. This ticker is OKLO, and we have here a bullish movement. It has done a good, tremendous breakout. As you can see, it has a resistance line at the top right here, and we have a support line right here. By clicking on the left tool called the array horizontal, you can click on the bottom and see that this right here is a consolidation worth of weeks. And you can check how many weeks by using the date and range tool. Click on the left side and drag it to the right. And now you can see it's 86 days. 86 days is about 3 months, 3 months approximately. So it's consolidating at this area. Now you have to say to yourself when to enter. Mostly people enter at the bottom of the support line, like so. Here's the first one, second, and third, and maybe and perhaps it would do it again on the fourth time. Now you say to yourself, where can I exit or put my stop loss? Usually people put a stop loss at the lowest of the 3-month consolidation, which is right here around $17. And you say to yourself, when is the best time to enter? You can enter at the previous low, which is right here, around $20, or you can enter right now and put your stop loss at the lowest of the day. But most importantly, you have to see the pattern. What kind of pattern is this? This is a downward slant right here. It has passed above it and now pulled back to that line. And we are waiting for a bounce back. A bounce back will happen pretty soon, but you don't know when. So we use a candle called the Heiken Ashi candle, located at the top left right here. The Ashi Hando candle, the Heiken Ashi candle, is delayed because it is an indicator that would tell you when to enter. When you enter, it is probably too late, about a day or two, but it's okay. It's better than nothing. For a beginner, it is a good start, but for a professional, they would look at the pattern, count the days, and see the resistance line. They would draw many resistance lines and try to keep it simple. Usually they'll draw about 3 to 5 lines and see and guess where it goes. And they put the margin between the stop loss and the entry and the target is called the risk ratio reward. The ratio of risk reward is calculated by first doing and picking your spot. How much are you willing to risk? For example, if you are doing $20 and you put a stop loss at 17, it's a difference of $3. $3 is a small amount, but if you're willing to risk more than that, you times it by a multiple of shares that you want. So 3 times the amount of shares you want to risk. So let's say you want to buy 5 shares. So 3 times 5 is 15. So you'll be risking $15. The only way you can put that in perspective is to think about your daily life. Your daily life of a cup of coffee. Are you willing to risk a cup of coffee which costs about $5 to $7? And you say to yourself, it's okay. But if you want to risk more, maybe twice of a cup of coffee or a meal, then you raise the price, you raise your risk. And then if you lose, you can skip the day of a cup of coffee or two. Now, we can check the depth of the consolidation, and typically we use around 10, 20, or 30, a maximum of 40%. Now it's about 35%. 35% is pretty shallow, but anything above 50 is very, very in the bearish territory. But right now, we can see that it's a bullish market because look at that. Look at that gap right here and a gap right here, somewhere right here, right there, the only gap we see. But the movement, if we check the volume and the movement, it is a dramatic endeavor. Look at that. When you hover over the volume and check on your left side right here, you can see it is at 54 million compared to 9 million, about 10 million, so about 5 to 6 times. That's a perfect amount because institutions are into it, and when institutions are into it, we have an easier time to play. When we have an easier time to play, we can ride the backs of the institutions and feel more confident and play out the price action. As long as the price action is above 17, we should be feeling comfortable because look at the volume. It's mostly green. And right now, it has low volume. You can enter it. But once you see a volume that goes up like this, red, then you have to be careful. Be careful because the ideal time to enter is when it has a low volume and it's about red and green, low volume. If it has a green and is a high volume, it's just an indicator to be careful and look at it. You can add it to your watch list. Now we can check the financials by clicking on the right side, right here. And the only thing that is pretty useful is the statement called the free cash flow. The free cash flow is located under statement, and you can look at the trailing 12 month. And as you can see, it's in negative territory. So you might say to yourself, this is a negative territory. Why should we buy this? We're buying this because of potential of making money. And there's a lot of AI robotics that needs energy, and OKLO has a nuclear that provides lots of energy to AI computing and especially quantum computing. When you look at the revenue and you see there's no revenue at all, then it's a disaster. So this is basically upon a storyline that you have to look at. The storyline and news. You know this is based on news and storyline. And the institutions are buying into news. And it's for you to do your own due diligence. Now, I hope you guys find this very useful and follow for me for tomorrow for the next ticker. Alright, congratulations, you guys. You guys got through this pretty quickly, and I will keep you posted daily. Goodbye.